Hello friends, this YouTube channel Learn Finance and Accounts is dedicated to the efforts put in by teachers and students in teaching and learning finance and accounts. In this channel we will be discussing various aspects of these subjects in detail. Please watch the complete video, like, share and subscribe to the channel. The topic that we are going to discuss today, that the name of the topic is inventory valuation. But before starting the discussion about inventory valuation, let us first know what is an inventory. So, inventory refers to the goods that are in the various stages of being made ready for sale. When a business organization starts its business, that business organization is required to purchase a raw material. Then, this raw material is converted into finished goods. All these goods are known as inventory. They are a type of inventory. So, inventory basically is of four types. First, we have discussed that is raw material. It is used to produce more finished goods, so we can have some finished goods already in our business. So if we want to produce more finished goods, then we require raw material for it. After raw material, its conversion process begins, and it is first converted into work in progress. So work in progress mean those goods which are not yet ready, but they will be made ready. So they are, you can say, in intermediate form. Then we have finished goods that are available to be sold in the market. These are basically the three type of inventory. There is another type of inventory which is called MRO. Now we will discuss these in detail. Let us first take an example so that it becomes more clear to you. Suppose there is a business organization which is into manufacturing sector and it manufactures cloth. So it turns cotton into cloth. The raw material that is purchased by this business organization is cotton, and the finished goods are cloth. But before cotton is turned into cloth, there is an intermediate stage. At this stage, cotton is turned into thread, and then thread is turned into cloth. So the three type of material are raw material, work in progress, and finished goods. The fourth type of material, MRO, stands for maintenance, repair, and operations inventory. See that the business organization about which we were just talking, that business organization is suppose using power loom. For converting cotton into cloth, you can use either hand loom or power loom. Hand loom example is charkha, and power loom where machines are used to assist in this conversion process. So in case of power loom, there are various machines, and for these machines we require various kinds of inventory like lubricants, like we require nails. So these inventory are required for maintenance, repair and operations. When the machinery breaks down, then we require some tools to maintain that machinery, to bring that into operations again. So these are the four type of inventory: raw material, work in progress, finished goods, and MRO. So inventory is generally the largest asset of a company. So inventory control and valuation of inventory is very important. It needs to be measured and managed properly. So valuation is the process of determining the current or projected worth of an asset. Here asset is inventory, inventory is an asset. So we have to measure the value of that inventory which we are having in our business organization. So this will tell us how much income and profit are we getting when we are converting the raw material into finished goods and selling them, and how much money we are getting, how much profit we are getting. So valuation also helps us to determine the financial position of the company. Say if we have say raw material, finished goods and work in progress, we can say that if we sell our finished goods or if we sell our inventory, then how much money will be having. So this will tell us our financial position, and this will also tell us our liquidity position when all the inventory is converted into cash. Then how much cash are we having? And fourthly, inventory valuation is required for statutory compliance. Statutory, what does it mean? It means following rules and regulations. In order to follow rules and regulations, we have to do compliance. For example, there are traffic rules, and the traffic rules say that whenever you are driving a car, you have to wear a seat belt. And following that rule is called compliance. There can be other rules and regulations which we have to follow. So, any business organization which is into operations will have to prepare its balance sheet and other financial statements. And in those financial statements, the value of inventory has to be written. So, how is this written? This is written as per accounting standard 2. So, every accounting function has its own accounting standard, and the accounting standard that we use for valuation of inventory is accounting standard 2. So in India, all the companies are required to do their valuation of inventory as per this accounting standard. Now we come to the question how to do this inventory valuation. So there are three methods of doing inventory valuation, which are the most common methods used. There are other methods also, but these three methods are the most commonly used methods. These are first in, first out, which is called FIFO, then last in, first out, which is called DFO, and the third is average cost method. These methods have their own advantages and disadvantages also. The method that a business concern chooses depend upon the type of business that they are doing. Now we will discuss these methods in detail one by one. The first method that we are going to discuss is first in, first out method, which is also known as FIFO method. So this refers to calculation of the price of inventory in order in which they are purchased, that is chronologically. So chronologically means according to the date when the inventory is purchased, the date and time. So FIFO method uses date and time when the inventory was produced. So you can think of a container where we are putting inventory. So that container can be say sugar in your kitchen. So we are putting an inventory from the top, and suppose there is outlet at the bottom where inventory is going out, then this is FIFO method. So this example you can take example of a water tank, storage tank जो आप the water tanks which you use in your houses, storage tanks. So there is a tap at the bottom. Water is going into the tank from the top, and water is coming out from the bottom. So if inventory is put in lots, so suppose they are put in lots of A, B, C, and D. Four lots are there. Then the first lot that we have to put in will be lot number A, then B, then C, then D. And the first lot that is taken out will be A. So this method is FIFO method. So this method is used in case of perishable assets, and it is also used in case of falling prices. Perishable assets how? Suppose you take an example of say there's a person who is making there's a shopkeeper who is making sandwiches. So for making or preparing sandwiches, that shopkeeper will be requiring raw material of bread. And if he purchases bread today on 1st of January, or today's date we can take, or he purchases on 1st of January, then he purchases some bread on 2nd of January, then on 3rd of January he gets order of making sandwiches. So which bread will he use first? He will use the bread that he purchased on 1st of January, because in 3 days the bread can become bad. It is a perishable commodity. So the first loaf of bread that we purchased day before yesterday, that we will be using today. Then that loaf which we purchased yesterday. So first in, first out. So this is the basic crux of this first in first out method. Then we come to the second method, which is last in first out method. This is also known as LIFO. So this refers to calculation of the price of inventory in such a way that the items of the last batch or lot purchased are to be issued first. So again, you can take example of that container, and you are putting in some inventory. You are putting in some inventory. Inlet is also from the top, and outlet is also from the top. So the first batch to be put in, first lot to be put in will be A, then B, then C, then D. That is the in. Out, which lot will go out first? The lot which was put in last. That is lot number D. So this is last in and first out method. So this method is used in case of durable assets, and it is also used in case of rising prices. The third method is average cost method. So according to this average cost method, calculation is done in such a way that the average of all similar items in the inventory are taken regardless of the date of purchase. So we take out an average of all the items of all the lots. So I will give example of say a petrol pump owner. So that petrol pump owner is a businessman, and petrol stations or gas stations have underground containers in which gas or petrol is saved. In case he purchased petrol on 1st of January, and that was purchased at say 100 rupees per liter, then he purchased petrol on 2nd of January, that was purchased at 101 per liter. On the 1st of January, he purchased 1000 liters. On the 2nd of January, again he purchased 1000 liters. Then he will be mixing that petrol in the same container. And to calculate the value of inventory, what he will do the averaging of all the inventory that is stored in his container. So this is average cost method. Average cost method. So we take another example. Suppose purchase date of inventory was 1st of January 20. Then some more inventory was purchased on 15th of January. Some more on 20th January, then 25th, then 30th. Number of items that were purchased is also mentioned, and cost per unit is also mentioned. So we take out the total cost, which will be 20 into 1000 in first case, in case of lot number 1, 15 into 1020 in case of lot number 2 or B. So we'll take the total cost. Total cost comes out to 113,300. And what is the average cost of inventory? Average cost of inventory will be total cost divided by number of items, which will be 113,300 divided by 100, which is 1133 per unit. So this is how we calculate by using the third method. So there are some drawbacks of inventory calculation of the value of inventory by average inventory costing method. What can you think of some drawback? So the biggest disadvantage or the limitation of this method is that it can be used only for identical items. Remember the example that I gave of petrol station? He was having petrol, so he was dealing in petrol and putting petrol in the same container. Now, suppose he is dealing in petrol and diesel both, then will he be able to put petrol and diesel in the same container? No, he will not be able to do. Bi- So, the biggest limitation or disadvantage of this method is that it is suited only for identical items, not for items which are not identical in nature. It cannot be used when the items are not similar. So, this was all about the inventory valuation techniques. We'll be doing some numericals also on this, and they will be discussed in detail in another video. So that's all for this video. I hope you liked it. So you can support our initiative